Happy Friday. Hey, this is Craig Modelmog for this week's episode of Wall Street X's and O's. I hope everyone is doing good. It's been a good week. Weather's been beautiful. Been a little chilly here, but which I like. I love fall weather here in Colorado. And you know what? It's been really nice. It's supposed to get a little warm this weekend and then get back to a little more seasonal. But hey, before I kick things off, let me throw out my little disclaimer. The content that is presented on this show is for informational purposes only. Oh, you can tell it's Friday already. See, for those of you joining me for the first time, this is uncut and unedited, which usually I verify that or validate that very quickly. Today it happened right out of the chute. So, you know what? It's all good though. But none of the information contained herein constitutes an offer to sell or buy or solicit any investment products. This is not tax advice. This is not legal advice. It's not investment advice. And obviously, what kind of investor that you may or may not be that is listening to this show, that's why we throw that out there. This is really for informational and educational purposes only. Investments can and will lose money, and they do on occasion. And without saying any more, we're going to kick this thing off. I've got a fabulous show today. Fabulous, I tell you. Top four things. We're going to talk about S&P 500 earnings and growth rates, which have been exceptional for Q3 earnings. We're going to talk about the 2022 IRS contribution changes as well as standard deduction changes. We're going to give a little inflation update here. Of course, it's transitory, or it's really just, not going to be sticking around according to the Fed and our other government officials, of which I've been barking up this tree for a while. And what's happening is it's coming to pass that inflation is a problem and it's not going away anytime soon. And then last, we've got some trend spotting things, some statistics or bits of information out there that make you go, So anyway, welcome. It is Friday, November 12th already. We are literally like 2 weeks out from Thanksgiving. Actually, one day less than 2 weeks out. That makes no sense. We are 13 days away. I think 13. I think it's the 25th. 25th, 13 days away from Thanksgiving. Happy Turkey Day early. But anyway, let's kick it off. I've said that already about 5 times. S&P 500 earnings. Earnings have been really, really strong for Q3, something that really wasn't anticipated. A lot of economists, a lot of Wall Street was really wondering if Q3 was going to come in as robust because the expectations or the hurdles that companies had to exceed was starting to get elevated. Let's see. Tell me what you think. This is as of today. There were 460 of the S&P 500 companies reporting. Overall average sales growth, and this takes in the averages of every sector in the S&P 500, year over year was up 18.7%. That is stellar. Okay. Earnings growth, this is exceptional. Earnings growth up 42.29%. That's a big stinking number. So, I think coming into what's happening with this quarter is that, you know what? Earnings are reaccelerating. I've been talking about that for weeks now, that I really thought based on the data and the rate of change of this data, we were going to see a reacceleration of growth in Q4 along with elevated and continuing to rise inflation. And that's exactly what we've got. Okay. Again, we got to keep our eyes on the ball. We can't get caught up in all these narratives and garbage that's floating around out there because it's really not counterproductive and it doesn't help us. Okay, moving on. 2022 IRS numbers. First, we're going to talk about contribution levels for people still actively working. 401ks. If you are under the age of 50, they kicked it up $1,000. You can now contribute a maximum of $20,500. If you're old like me, as I say, the bonus you get for getting old is you get catch-up contributions. So you still have that $6,500 catch-up, which makes the overall max contribution that you can put into your retirement vehicle in the form of a 401k up to $27,000 for this year, which is really exceptional. IRAs didn't change, Roths didn't change. It's still $6,000 plus you get the $1,000 catch-up again, the bonus for being older than 50. Okay. Let's talk, and I had this up and ready to go here. Standard deductions is another one that really kind of popped out here. Standard deductions is set to raise to $25,100 for married couples filing jointly for 2022. That's a $300 increase, to be specific here. And the $300 increase comes in the form of, what is this, 2020? For 2023, timeout. 20-second timeout here. I'm doing some little signaling here. Standard deduction raises to $25,100 for 2022. It increases, which is an increase of $300. In 2023, it increases to $25,900, which is an $800 rise from current levels. If you are an individual filing as a single person, the standard goes up to $12,550. There's a $150 increase, which you can see is half. And then for 2023, it jumps up to $12,950, which is a $400 increase. What that means is that you get that standard deduction. The only way you should itemize, and again, we're not supposed to be giving tax advice, and I'm not. I'm quoting the IRS page here, okay? So don't get a little bit foxy on me here. What it means is if you, the only reason you would need to itemize is if your standard deductions increase above these rates. So which hits some people, doesn't hit a lot of people, but that's okay. So important to know and to understand. For you that have health savings account, if you are filing from a joint standpoint, HSAs for 2022 increased by $100 up to $7,300, and if you are a single tax-paying filer, dang, I'm struggling. It increased by $50 from $3,600 up to $3,650. So usually these are kind of normal instances where we do see these things continue to crank up and get higher, which is a good thing. Moving on here to inflation. Oh man, you knew we had to go back there. You just knew it. Couple interesting stats before I really dive in here. These are good. These are really, really good. Auto sales, used cars hit an all-time high. And this goes back to only 1995, okay? So we're talking 26 years, but still, I would probably argue that it still would be an all-time high. From a monthly standpoint, month-over-month increase was 9.2% increase in used car prices. So if you're going out and buying a used car, last month you paid more. Year-over-year increase is 38.1%. That's up there. That is just up there. If you look at real interest rates, Craig, you say, well, what the heck is real interest rates? Well, what it is you take the interest rate, like the 10-year Treasury, which the 10-year Treasury, what did it close at today? See, now I've got to juggle my screen around because I'm farting around here and getting off script. Not a shocker, I know. Not a shocker, because Craig is just an off-script dude. Here we go. The 10-year Treasury closed today at 1.58%. If you take that number, see, now I got to recreate everything so I'm in order, and I really don't look like a moron, which I know is incredibly challenging sometimes. But if you take the real interest rate, which is 1.5 and change, minus inflation, that gets you to what your real rate is. So it basically removes the effect of inflation. Here's what's fascinating about this. As of right now, the real rate in the United States is a negative 4.66%. That exceeds the high back in 79.80, only to be exceeded by 1 year, which was 74.75. I think we eclipsed this. Interest rates are rising subtly, but I think what we're going to see is inflation is going to continue to rise here, and I'm going to get into a more granular explanation of that. But as inflation continues to rise and interest rates don't move or don't budge much, that negative real interest rate is going to continue to be negative. And if you look across the entire yield curve, from 1-year Treasuries out to 30-year Treasuries, you know what we see right now? They're all negative right now. Pretty fascinating. Pretty fascinating. So if we move on here, now we're really diving in. So here's some thoughts. Okay, government first said it was transitory. They didn't believe inflation was going to be sticky or high. Now they're starting to sweat some bullets. But then you've got Powell, who's an attorney. He's not a finance guy. Don't mistake him for a finance guy. He's an attorney. He made a buttload of money in the big world of hedge funds and venture capital, and now he's the Fed chairman. And then you've got Janet Yellen, who's a labor economist. Well, you've got all of them supporting what the current administration is saying, which right now they're trying to figure out how they're going to handle this bear that got out of the cage. You've got Biden here talking here this week talking about he's going to require that prices be lowered for oil, for all these things. And I'm like going, dude, you are nut job. That is not even possible. Okay. That would be like me trying to say, well, I think, Joe, I think you're a nut job and I think you should resign. He would say, Krager, you know what? That's not happening. It's just not happening. Okay. The government doesn't have any control over pricing. They can try to control things, but they are challenged with things. This inflationary gig is going to continue to run hot through Q4. I think we have the potential of seeing it peak towards the end of the first quarter of 2022, most likely into the second quarter of 2022, or then you could see the economy begin to decelerate along with inflation. That's an interesting cocktail. That's like better than a fill in the blank there. See, I haven't had a drink in so long because of my COVID experience that I can't even remember the name of my favorite cocktail. It'll come to me here. But anyway, so looking at that, I think we're going to continue to be challenged on the inflation side. Okay. If you look at this week, here's some other numbers to support that. PPI came out, accelerated to a 30-year high of 6.22% year over year. That just came out this week. PPI is the producer price index, okay, which is what it costs for people making things. And if you look at CPI, which is the overall inflation rate, it was up 3.7% on a 2-year basis. So this doesn't include the garbage that happened during the pandemic. This goes back 2 years. Because to me, you got to throw out 2020. Okay, it happened. Yes, I'm not saying that it didn't, but you can't utilize those numbers looking at this year. You got to go back another year and really look at 2019. Well, if you go back 2 years, CPI increased by 3.7%, which is significant. Okay, and here's what's interesting. I've talked about the shelter component of CPI, which makes up a third of it. It is just starting to accelerate. And it accelerated up to 3.5% year over year increase, which gets back to a historical average if you look back over the last 2 decades. So to me, we are back up to historical averages, only now we're going to see it exceed. So then as those numbers come in, it's going to continue to drive CPI inflation up. It's going up. I've been saying this for a stinking long time, and my consensus is not changing, okay? So how do you combat that? In an environment where you have the economy accelerating along with inflation, things to look at. 1, small caps historically outperform. 2, technology historically outperforms. 3, financials historically outperforms. These are things that you have to look at and be aware of when you're looking at how am I positioned, okay? Because that positioning is crucial. And the kicker is you have to get there before things start to change. That's where when I look at my research partners, they're really good on front running the data because of how they really bring in the data and how they calculate it and they look at it. They don't go from a point to point because, to go back and use an old geometry term or a calculus term, a secant they draw as a straight line. All economists, that's what they do. Well, it's up here, it's at 5.5. Well, it's going up here to 6.5, and they just draw a stinking line, and they have no clue how they came up with that number. They're just drawing a line, and there's really very little basis for it. That's why none of the Fed government projections on interest rates, on inflation, on any of that stuff, they're always wrong because of how they factor in. They don't factor in, I should say, the rate of change. So by factoring that in, we're able to get out and front run what's happening, which is really, really helpful. Okay. So we're going to continue to really work on this. On the inflation thing again, and then I'm gonna wrap this bad boy up. Some things not to do right now. Okay, one would be going out and making very high-priced, elevated asset purchases. That would be other pieces of property, buying a new house just to buy one, buying a second home, things like that, because they're illiquid and they're at super high, elevated prices. And those are going to, eventually it rolls over. Okay, it just does. Maybe not throughout the entire country. We're blessed here in the Front Range of Colorado where our prices are just continuing going up and up. And there are pockets around the country where that is happening. But, you know, not everybody can count on that. So we really can't count on that. But that would be one thing. To close the inflation out component, I can't emphasize enough asset allocation. So for you people, look at your 401ks. Look at your other things, and you have to look at what you own and see what's happening. Now, the problem is you can't just say, well, Craig, I heard you say that, so I'm going to go move my money out. No, you're too late. Don't do it now. You have to wait until the data continues to germinate, and that's kind of a rhyme. Wait until it germinates. Wow, I'm singing songs now on Friday afternoon. See, I told you it gets better. It gets nothing but better. But anyway, see, my phone's ringing now. Make sure it's not Tanya. Nope, it's someone else by the name of Larry, and I can't answer that right now. So anyway, so that's the story. So like I said, we've just got to keep our head down. We got to keep our eyes focused on the prize, and we have to ignore the garbage out there. Lastly, trend spotting, the things that make you go, I think the last time I sang the song, I'm not going to do that and further embarrass myself. So here's what's interesting. Crime is rising throughout the United States. That is a fact. Okay. And what's funny is we had this narrative spinning around last year about not wanting to, or actually wanting to defund the police. That's been a very prominent thing that's been discussed. What's finding is amid rising levels of crime, police departments around the country are getting their funding back, and they're not just getting back what they were cut, they're getting more. See, and I'm not going to say any more. I could go off on that and really get kind of offensive, and I'm just not. I don't need to. The data speaks. Moving on here. College enrollments first plunged last year during the pandemic, okay? Well, they've dropped again, okay? Which is interesting. So you saw undergraduate enrollment for the fall of 2021 fell an additional 3.2% from 2020, which was during the pandemic. The only part that you didn't see change, and I was looking at this, a few exceptions were highly selective schools, i.e. Ivies, okay, and then also graduate programs. My daughter is in one of those. She's in that statistic. God bless her. I'm really proud of her. She's a stud for graduate school. So I thought that was one thing that just made you go, interesting. Cost of education skyrocketing. People are looking at different things. The thing is, we don't know what all those people that normally were applying for college, what they're doing. The data didn't go that deep. Lastly here, this is great. There might be some of you that when I talk about vinyl record sales, you could be absolutely puzzled. You could be like going, Craig, I have no clue what you're talking to. This is a hot deal. This is a really hot deal. This is really kind of fascinating. In 2021, okay, vinyl records, the sale of vinyl records. So let's take a step back in time. Initially, when the music was created, it was recordable on vinyl records. That's called a record player for those of you that are youngsters, okay? That transitioned to 8-track tapes. What that meant is you put the tape in, you press play, you couldn't choose a song, it just played from beginning to end. Then as they really stepped up their technology, you could fast forward it. Not an exact science, never worked, but it didn't matter. Then that germinated or transitioned into cassette tapes. Same thing, you put it in, you push play. If you wanted to forward and rewind, you could try to get to the next song or whatever. Not a perfect science. That's what you had. Then, CDs came, and we had these CD discs. which you could put them in, you could listen to a song, you could move to the next song, you could go back, you could record. It was fabulous. And now we have digital music, which throws all that garbage away. Well, guess what? Now the sale of vinyl records is exploding. The total sales of vinyl, now let me find my stat here, generated $467 million in revenue in 2020. That was double the amount that actually, you know what? I'm saying, I'm not even going to read my stat here. It said the first half of 20, Americans bought 17 million records. That doubled the amount sold over the same time period of 2020 and generated an additional $500 million in revenue. So vinyl is not dead. Isn't that awesome? I love it. So anyway, it's been a blast today. Wall Street X's and O's. This is Friday, November 12th. I love you guys. This was a lot of fun today. Lots of good stuff. Going to continue to challenge you guys, and because we want to get better. We want to get better. And at the end of the day, that's what it's about. So this is Craig Malamog. Thanks for joining me. Wall Street X's and O's. And I am out.